Welcome to CPA Australia's webinar, Practical Solutions to Manage FX Payments, sponsored by OFX. My name is Eleanor Casapedes and I'm the Senior Manager of Tax Policy for CPA Australia. We have people joining us from all over the country for today's webinar, so I would like to take a moment to acknowledge the traditional owners from around Australia and pay my respect to elders past, present and emerging. I extend this acknowledgement to all Aboriginal and Torres Strait Islander people who may be joining us today. We will be taking questions through our Q&A box today, so please direct questions to all panellists and we will address questions as we go along if possible, but also if there is time at the conclusion of the session, we'll do our best to respond to your questions. For any troubleshooting queries, please send a message to the host using the chat box. So in today's webinar, we will cover demystifying FX, tax and key currency considerations, and how to manage FX risk. It's now my pleasure to invite Michael Judge, Head of Australia and New Zealand OFX, Joel Holmes, Senior Corporate Client Manager OFX, and Dane Hart, Head of Enterprise Sales OFX. Michael, over to you.
Hi, Eleanor. Thank you so much for that warm introduction. As I said, delighted on behalf of OFX and the CPA of Australia to be part of today's webinar. Eagerly delighted, as you mentioned, to be joined by two of my colleagues, two gentlemen I've worked with for a number of years, Joel Holmes and Dane Hart. Look, just to start with, look, we've got a pretty jam-packed agenda. As I said, we're hoping, I suppose, that today's conversation will be exactly that, and that it is interactive where it can be. So again, please use the Q&A facility, as and where you choose. Conscious as well that a lot of people today may or may not know a great deal about OFX and us as a business. So I think, a starting point is just to ground the conversation briefly, albeit around OFX, and just to provide everyone a little bit of context around what we do as a business. Look, back in 1998, OFX was essentially founded on this core principle that there had to be a better, fairer and simpler way to move funds globally. Essentially 20 years later, those core principles, I should say, are still very much real to us. And our core role for a lot of our customers in helping them move funds globally is to remove some of the anxiety, complexity, and ultimately some of the costs which are far too often associated with moving funds globally. OFX is an ASX listed company. We're proud to represent 400 employees and over 1 million customers globally. And while we are very much a business with a true and proud Australian heritage, we are located and spotted globally, and we are located from a banking and regulatory perspective, as well as a physical presence in 8 different countries across the globe. Before I jump into some of the, I suppose, the media content of today's webinar, what we did want to do, as I said, not just ensure that it is interactive, there will be a couple of polls throughout today's webinar. And as I said, before we jump into some context, I think it's really important that, again, we start with a question. It's a relatively open one. And what I would ask for everybody, if we could just get a bit of a read on the room, if you like, in terms of which common FX challenge most resonates with you. And I'll give everybody probably just shy of a minute and we'll collect some of those responses. Okay, we'll just give everyone just a little bit longer. Okay, the results should be coming in now. Okay, Eleanor, I'm not sure whether you can see the results. I can't see the aggregated responses on my side just yet.
Neither can I, but I know that I responded that I was unsure of what I'd be charged.
Okay.
And there we go. We've got unsure, the fourth one.
Okay, so
the largest number of responses.
Yeah, interestingly, 58 participants, they did register that they were unsure of how to help protect against currency volatility. 32 participants, the second most used response, kind of spoke to, I suppose the pricing element, which sits beneath, the provision of FX services. So, that gives us some pretty good insight. Some of the two key themes, I suppose, that not just myself, but Dane and Joel alike will obviously be covering, will be those two things. The first is around, I suppose, demystifying, some of the lack of transparency, or if anything, a level of uncertainty in terms of how FX rates are calculated, and more importantly, how they're consumed by the end customer. And I think, secondly, and equally just as important, particularly for a lot of CPA members or accountants who are representing corporates or SME customers, providing some, I suppose, basic tips or some fundamental tips in terms of how they can mitigate FX volatility. So look, what we'll do, we'll kind of jump into some of the key themes which I wanted to cover, and this is kind of, I suppose, umbrellaed under the topic of demystifying the FX market, I think, in a broad sense. I'll take the lead predominantly on this slide, but again, I am located in the OFX boardroom today, and Dane Hart is sitting across from me. So the two of us will probably counterpunch a little bit throughout the course of some of these topics. But as I said, as a starting point, and again, it links but directly back to that starting poll, is this topic around how FX rates calculated. And I suppose, representing corporates, consumers, a lot of partners from OFX's perspective, to be fair, it's a question which is often asked from a lot of our customer-facing teams. And the reality is that the FX market globally is an absolute beast. $6 trillion worth of turnover passes through the FX market every single day. It's highly liquid, and to some extent, it's highly accessible. But I think what's really important to understand is that, again, the way that FX rates are calculated, it can be simplified. And I think from a starting point of view, look, there are only 2 to 3 key variables which determine, frankly, the types of FX rates which are presented. In all exchange rate calculations, look, there is a buy currency, there is a sell currency, there is an underlying, I suppose, maturity date. It's those 3 variables which will obviously impact in the main what type of FX rate is presented. And what I do want to do throughout the course of all of these considerations is try to reference it to 1 or 2 particular examples. And what I'll do is I'll start by the example of a customer. Very simply, they are looking to sell Australian dollars, and they're looking to transfer US dollars to the United States. I'll come back to this example quite regularly. In that type of example, OFX, by definition, look, we are a wholesale provider of foreign exchange services. Now, what that means, again, this is relatively OFX agnostic, I suppose, in its definition. But what that does mean is that we have access to wholesale or interbank exchange rates. We have an entry point into, multiple currencies, and we do have access to wholesale exchange rates. Wholesale exchange rate universally is defined as the baseline to which us as a wholesale provider can access funds and sell them to our customers. Ultimately, the rate which end customers consume, or in fact priced at, is defined as the customer rate or the retail rate. So for absolute clarity over a traditional model, all we are simply referencing here is a wholesale exchange rate versus a retail or a consumer or a customer end rate, if you like. Now, the variance between a wholesale exchange rate and a retail rate, again, very simply is defined as the FX margin. Now, again, why these definitions are important and why it can actually become quite complex to work out, frankly, what that margin is that there isn't necessarily a universal way in which these margins are presented, communicated, or in fact consumed by customers around the world. And what I mean by that is that, again, the wholesale exchange rate, if you like, if you come back to that baseline or core premise, it can be seen, across your Channel 9 news in the evenings. It can be seen on a simple Google search. There are a lot of, charts available. The wholesale exchange rate in the main is relatively accessible by all types of customers. The way that the end customer rate, however, is often presented may or may not include a raft of different fee structures. It may include a cost to fund that deal on the Australian dollar side. It may include some costs related to the settlement of the US funds on the other side. They may actually be a cost in itself just to execute or enter into that, spot transaction, if you like. If you aggregate all of those costs, you add in a margin, again, it does, I suppose, lead to a loss of transparency in terms of how people are perceiving this underlying calculation. Again, I'm very conscious of making sure all of these considerations are presented, I suppose, from an industry standard perspective. But what OFX does provide in terms of its pricing approach is that it is relatively transparent, very simply in terms of we do have access to wholesale markets, and we do provide retail rates which are baselined against those wholesale rates. When I started, I suppose, a conversation around FX rate calculations, look, as we said, they're based on a buy currency and a sell currency. They're also based on the date of settlement. And by definition, a spot exchange rate is very simply defined for settlement tomorrow. So what that means is that in this same example, a customer would be purchasing US dollars today for a settlement date tomorrow. So their obligations in that circumstance is to make an Australian dollar payment today for an underlying maturity date against that spot transaction for tomorrow. Now, the underlying exchange rate may start to vary as you push that maturity date or that settlement date out into the future. And this is when we start to get into forward exchange rate calculations. And my colleague Joel, he'll talk a little bit more deeply around forward exchange contract usage. But again, very simply, what it means as you move from settlement tomorrow to settlement in 1 week's time to 1 month's time, potentially all the way out to 12 months, we are still making an underlying purchase of US dollars on day one. An exchange rate, however, which represents that purchase will simply vary based on the length of the underlying forward contract. So as I said, FX rates, just finally, again, we're trying to demystify it. We're trying to make this universally applicable. The reality being that, again, wholesale rates and retail rates are relatively well defined. The complexity comes more so in terms of, again, how they're presented. I'm just looking across at my colleague Dane. Is there anything else that you kind of wanted to, add some color around, this proof point?
I think maybe from a perspective of the accountants, I think, and for your clients, really when you know what the rate's going to be in a very basic way of calculating that, I would say is how much is going to come out of my bank account. So something that often people get confused on when we hear from our partners and our clients is, how do I know what that equals? So there are 3 elements that I would take from Michael's clear explanation is you can actually see what the interbank rate is on the day. And it gives you an understanding. The interbank rate moves all through the day, but it gives you a fair guide to say what's the underlying cost of those funds and that Aussie dollar to buy the US dollar. Then there's a margin. Now, this is generally the part that I would say, if you're taking this away, is a very, very strong guide to see what is the underlying or the end state cost for that transaction. And therefore, that's the contractual part. That's the part that you have with your provider. So it's how much of an additional margin or a spread is going to be charged that is under that interbank rate. That's where the partners' margins generally come in. And then there's the third part that we'll talk about in a little bit more detail in the next section, which is fees. So the fees to move and what are the real end costs to move that money. But what I would say is when you're trying to put this together and actually better understand it, if you work on those 3 principles around what is the daily rate to buy the currency. And in our analogy, it's, you know, you're buying US dollars and we're in Australia. How much is actually going to come out of the bank account? So there's the cash flow impact. That really the two major factors that Michael explained is what is the underlying margin, or what's the committed margin that you've agreed to, or the clients agreed to with their provider, is really the and that can float. But what's that margin under interbank, and then also under the wholesale rate, to be more accurate. And then secondly, what are the fees that are likely to be charged? That's back to you, Michael.
Thanks, Dane. Look, I think that the second part here is an acknowledgement that once a spot or a forward rate is secured, what's really important to kind of unpack, and I think what is, I suppose, universally somewhat misunderstood is, I suppose, just practically, how funds do transfers from a customer's bank account. Again, if we use the same Aussie US example, how does the money practically and physically flow out of an Australian dollar account and obviously land in the ultimate recipient or the ultimate beneficiary account, again, in this example, which would be US dollar based. So I think in that, again, using this example, the easiest way to kind of articulate this back to the audience is to say there are two key components here. One is on an entry and one is on an exit. So again, there is a underlying flow, and what I would say firstly is that the inward flow, so the entry point of the funds is relatively straightforward. A customer would be essentially EFTing or BPaying a payment out of their existing account into either OFX's or their underlying provider's bank account. As I said, we're relatively fortunate here in Australia that our banking rails are very secure. They're relatively quick and cost effective, and a domestic payment is often same day, and there's often no cost associated with it. So the entry point, which undersits this FX transaction, is incredibly straightforward. It's frankly no different to an everyday domestic payment, if you like. I think the second part to the underlying flow of funds is obviously the exit point. So this is the outbound payment. Now, again, I think what is probably most misunderstood about the exit point is that it is often, associated to being, again, it's simply a domestic payment. So again, if you view it that, I think too often people view the movement of funds as being cross-border related, or, hey, there is an international money transfer. Could be doing a telegraphic transfer or an international wire. But again, the reality is that there are a whole heap of providers out there which are very well credentialed on a global scale. And what that means is they often will have locally funded domestic US dollar accounts, which are already funded sitting in the United States. As a result, this basically means that the exit point of those funds is equally a domestic payment. So you might be sitting here in Australia saying, look, I've got to send funds to the US. But the reality is that is simply broken down by an entry point, which is a domestic to domestic bank transfer, and an exit point, which is again equally a domestic to a domestic transfer. If a provider is well credentialed on a global scale, again, it's got multiple accounts, it's got funding and liquidity pools all around the world, and where possible, the most efficient and effective route from an exit point of view is where, again, there isn't a cross-border leg associated at all. It is simply a domestic release of payment. I think, the second model, and I will pass, kind of back to Dane to perhaps provide some detail around that. But, the second model before I do that is an acknowledgement that it isn't always, that straightforward. There isn't always a domestically funded account which we can release a payment out of. And as a result, look, the funds ultimately will need to pass through either a web or potentially one or two different counterparts in order for it to reach the ultimate recipient account. Again, the most common example I can probably offer, if we use that same example, the corridor is the customer selling Australian dollars and buying US. The US dollars, however, in this example, are going to mainland China. In that example, there would be a domestic to international route on the exit point. There would be a requirement to make an outbound payment from the United States. Funds would ultimately pass through an intermediary or corresponding bank, and the payment would ultimately land in the end recipient bank in mainland China. However, it would get routed by a third-party correspondent, which would in turn, obviously, potentially, impact things like a fee or a handling cost, as well as potentially, slow the leg of that outbound payment down just slightly. Like I said, that is, suppose, the overall hierarchy. An acknowledgement, there's an entry point and there's an exit point, very simply. This is all supported by the relationships between banks and ultimately the relationships that your provider has with a lot of those banks as well. And if there is a direct relationship, so again, if we use an OFX perspective on this, if we have accounts which are in our name and we have multiple relationships, in Aussie about 14 global banking relationships, where there is a direct connectivity there, obviously the efficiency, speed and cost associated with the in and outbound legs is vastly improved. And that's why the global piece is quite important to the underlying flow or movement of funds. Dane, is there anything else that you wanted to add, just more in terms of the types of domestic exit payments, or equally the cross-border piece that I mentioned?
Yeah, let me add a little bit of context. I think there's commonly discussions around, well, what does that really mean? So the payments traditionally in Australia, we have a very simple model that Michael's mentioned, BPay, a pay anyone transaction that incurs no cost to the end client. However, there are other ways that you can pay your providers. So if you were choosing to pay via a card or a credit card that adds a much higher margin, there will be a cost to making that transaction. And sometimes that cost can outweigh the total cost of moving funds. So that's a major consideration. If they're making a bank-to-bank transfer, then especially in the Australian market, there's almost no end customer impact or the client impact. But if you're paying via a card, even though the money might be coming out of exactly the same account, you could incur the 1%, 2%, or 3% cost to move those funds into the account. On the other side of it, when it's the money leaving the account on the interbank or on the other side of it, there's a really big consideration around time. So there's two major costs. Time is either if you need it to be presented or paid out in real time, there is a much higher cost, sometimes up towards $30 to actually release those funds in the same day. Or if it's able to be paid out domestically, so over a couple of days where the funds land, it can come at a much lower cost. On transaction sizes, anything up to $20,000 or $30,000, that can be really material in the sense of the total cost of the transaction.
Cool, thank you. Look, ironically, we mentioned time and efficiency. It's apparent that we're probably taking a little bit too long on this slide, but look, nevertheless, I'll probably jump in around the AML and KYC piece and kind of just run through that briefly, because I know there are 2 or 3 other elements to today's webinar. But look, I think the other key question that we often get asked, and I think I know is incredibly important to a lot of our partners and to our CPA members who are optically putting a lot of trust, not just in OFX, but in the end service providers. Can you hear me okay?
We were hearing Michael really well, and then you cut out.
Sorry,
so I'm not quite sure.
We're not exactly sure what's going on with Michael's computer. I might just pick up his piece and then try to let Michael rejoin if his audio will come in. So I think the compliance side, the key factors, I mean, it's very topical in market around what does AML and KYC actually mean, and why there's so many misnomers in some cases, but there's a lot of lost understanding around why compliance is so important. So I think the 3 factors that I would say is, when we're moving money cross-border, there has the impact to be lost. It can be misguided, and obviously there are major implications to major brands, but also to people about inaccurate payment movement or identification. So what's required is we need to make sure for all providers that it's a clear understanding of who the people are, why they're moving the funds, and what are the sources of funds. This is really foreign for most people when it comes to moving money in a domestic sense, because there's no need to provide this information. However, from our point of view, and to be able to operate in a market that's highly regulated and a global footprint, these pieces of information come with the transaction. So when you're moving every dollar cross-border, regardless of its size, we are obligated to provide all this information, or at least store and identify this information, to ensure that there are no risks, that there's no money laundering created, and we know that the person's secured. The second element to it is, when I say about being the person secured, we also need to ensure that there's no risk of someone's account being taken over, and therefore people acting on their behalf. So all providers now will take a much more clinical and consistent approach. And I would say that the underlying benefit, and also the underlying expectation for yourselves when you're talking to your clients and also when you're operating yourselves, is we need to be able to fully identify the people that we're doing it and the purpose of their transfer. So therefore we can meet those obligations, keep everybody safe, and ensure that the money can land in the right place at the right time. I'm just going to test to see whether Michael, sounds like Michael's microphone's working, so I'll hand back over to Michael to complete this section.
Thanks, Dane. I think I'm back online, which is good. Very briefly, just around the spot versus forward calculation. Conscious of time, but this is going to offer hopefully a really good segue in terms of FX risk management. Again, comes back to this theme that a lot of customers do come to us with a requirement. They want to understand how they can actually manage that risk better, whether that's at a transactional level or whether that's over a longer period of time. So, i.e. corporate customers which have ongoing exposures over prolonged periods. But the reality is, as I mentioned previously, spot rates are fundamentally different to forward rates. Typically, the reason why forward rates do vary in terms of how they're produced and consumed by customers very simply speaks to the fact that, look, there's added risk, firstly, and I think secondly, we are still making an underlying currency purchase on day one. And if, for example, we were to purchase US dollars today and the customer was not looking to settle that underlying purchase for 12 months' time, there is often a storage cost associated with us holding US dollars when in fact, in the absence of that underlying contract or underlying exchange, would be holding Australian dollars. So the interest rate components between US dollars and Australian dollars does matter. Again, if I was to play a little scenario by everybody, if by example interest rates in Australia, very simply, but today we're set at 0%, so that's the RBA headline interest rate of 0%. If the FOMC, so the US Federal Reserve, if they set their interest rates out at 5%, very simply, what that would mean, all things else being equal, in that the forward rate in 12 months' time would be 5% roughly above today's spot rate, because we are holding a high yielding currency for the full course of the underlying contract. So what I'll do now briefly, I'll pass back down to Dane for the final part before Joel jumps in.
Thanks, Michael. So the next slide we're going to show you is a couple of examples, and what we felt was really appropriate is to bring to light what that actually, some of those examples of what your clients may impact or may receive. There's obviously a reason to move the funds that we already have identified, but then there is actually the purpose of why they need to move the funds and the process that goes with it. I think the key things that we're going to talk through, and I'm hoping that slides will catch up to us shortly, are kind of two elements. I have a reason. So commonly, one of the three most common use cases that you'll see at the very top is I'm selling my shares. And this is common for, especially in Australia, we've got a lot of companies now that are doing quite well. They're listed in the United States. Atlassian is a great example of ours. So there are a lot of people that are holding shares. Their shares vest. They live in Australia. They've never actually done an FX payment before, but now they've got to sell those shares and bring those funds home. So obviously all the foundations that we just described will be agreed upon with the client. How much is it actually looking for and what do they actually need it to do? That's the key fact. Now it's what they have to do. So we support the client in most providers will actually support the client in understanding how to move those funds into a bank account and then also back to Australia. The process steps that I think it's really important to consider is what we describe with the compliance side is source of funds. What are the sources of funds? where are the funds moving through to get to a bank account that can return it to Australia? So the considerations here is you're going to sell it from somewhere. Those funds are actually going to get paid into a bank account somewhere else. And there needs to be proof of why those funds came out. So again, when you're thinking about supporting your clients to do this, they need just to have a good understanding of my money is going to be moved. It's going to have a purpose. So I need to get the evidence to that. What was the share sale for? And then the money needs to land into the provider's bank account. So then the rest of the FX payment can be achieved. There's a second example that's even more complex, but more exciting. For buy now, pay later companies. So you'll have a lot of companies in Australia now, and especially in the post-COVID or the now COVID world, that are now operating overseas. We'll continue with the US analogy. So Afterpay merchants could be selling their goods in the United States or out of Australia. They're still an Australian company. They need to get paid by the person who's purchasing the goods from them or their provider, and they'll receive those funds in US dollars. So those funds will then land into their US account. They may store those funds. They may move those funds back to Australia, and also they may make a further hop. So a consideration for you is if one of your clients is operating, and Afterpay is a wonderful example, they can get paid from Afterpay, they can get paid from Amazon, they can get paid from multiple platforms. Those funds might actually come into their FX provider's account and be held offshore so that the funds can remain in US dollars. What they will have is a series of ledgers that will ultimately appear in Xero or other platforms. But the point is that they'll be receiving those funds in US dollars. The next thing to look for is they may choose, because it's more beneficial to them, not to convert back to Australian dollars, but to make the next FX purchase. So they may be paying for goods or like acquiring goods within China, the Philippines, anywhere. So they will make actually a further payment, but they will convert from US dollars across to China, whichever currency we're talking about. Following that payment still is actually a transaction. It will still be, in most cases, actually tracked within their account. But ultimately, there's further transfers that can occur. And it's very common when they're talking about the foreign marketplaces operating, but ultimately there'll also be a payment back to Australia. One further example to this is there may also then be a tax obligation. Something that we can talk to with a level of understanding now is actually making those payments when you're living outside of Australia, whether you're a corporate in the example that I was just giving you, or the first client that I was talking about that is generally an individual or a consumer, paying to a tax agency. So the ATO in Australia's case, or the IRD in New Zealand, there is actually a sequence that you need to provide. You need to make sure that the payment obviously lands in a full amount in the local dollar. You need to be able to actually provide payment reference information to ensure that actually reflects back to your individual obligation with the ATO or whichever tax provider. So 3 considerations that I would say are really important for you to think about for yourselves and your clients. One is, how is that money going to hop? So how long does it take to get the money back into the end provider? So an example that we have just done is we've identified that there is the payment reference number for the ATO, and anyone overseas from an OFX perspective now can actually pay to the ATO in one step. The considerations that they need to make, however, is that when you look at the underlying costs to move those funds, and something to consider for your clients, is they need to consider their existing bank account and their existing bank as to what the cost to move the funds into a FX provider like us is. The second thing is, how much exactly do they need in the Australian dollars? And the third thing is to consider the time. So to move the funds, as you would know better than we do, there is a date and a specific date when interest starts to be charged by any of the agencies, the ATO and other government companies. What I would say is consider with your provider how long from when I make the payment today in the full amount to when that payment needs to be reconciled, and then talk to the provider around the speed in which therefore you may need to pay a fee to get the funds moved real time, or you have the time to move it across. All of these factors really do result in a seamless process if you get it right, understanding the whole dollar amount that needs to be landed, and also then just the considerations that my account or my bank may actually take funds out of that transfer. So I may not be landing the full amount and then putting myself in that position. Hopefully that gives you some understanding of process. And also just consider the takeout is consider what may be required to make sure those funds move, and the pieces of evidence outside of the actual payment that are needed to be provided or considered to make sure that the funds land correctly. I'm going to hand over to Joel, I believe, right now, who is one of our most senior dealers. He works with some of our most engaged clients and some of our most complex clients to bring to light. Oh, I'm sorry. I'm handing over to Eleanor. My apologies.
That's quite all right. I was going to let you do the amazing introduction to Joel because it would be better than mine, but I will steal the limelight for just a few minutes because it was a nice segue from Dane's commentary just into the tax and key currency considerations. So the OFX team have obviously given us a very insightful and, for me at least, eye-opening explanation as to how all of the funds move. This is a little bit more centred on just Australian tax, and I think noting what Dane was saying in terms of making payments to the ATO, when would clients, especially for practitioners in the individuals and businesses section, ever need on behalf of their client or to work with their clients to make payments that would require potentially an OFX or a Forex transaction. So the changes to HELP a few years ago, where if you leave Australia, you still need to pay back your HEX or HELP. Those are things where people residing offshore, unlikely necessarily to have an Australian denominated bank account, they're still going to have to pay their debts to the ATO in Australian dollars. We also have a large number of foreign residents, foreign tax residents who own residential dwellings in Australia who may need to lodge and pay with their vacancy fee returns. And then GST from overseas. So these are actually clients that may operate or I guess you could say export to the Australian market and need to remit GST to the ATO on services and digital products and low value imported goods. So there's some of the perhaps lower value transactions, but they can be quite common. And given the globalisation and diversity of businesses and individuals, quite often many agents or many businesses will have somebody that they interact with that may have these obligations. On the next slide, individuals as well. We also have a lot of people where they might be investing overseas. So a lot of the time exchange traded funds over in the US stock exchanges, things like that. They might receive exempt foreign employment income, non-resident withholding tax amounts. And so I guess it's just a matter of making sure that when your clients, particularly for tax agents, come in and asking them about, do they have overseas investments? Do they have foreign income sources? Have they paid or do they need to pay foreign jurisdictions? So they might have a US tax obligation, for example, that needs to be paid to the IRS. So given that our investment patterns, our transaction patterns, and how we work and reside across the world are changing, it's good always, I think, to have an understanding of when this issue might come up and also have an understanding of what your client's options are. Is it banking? Is it OFX? What gets them the best deal, or what are the considerations that they need to have if they enter into this kind of territory? Just on the budget, individual tax residency rules changes to that have been proposed. And just on the more corporate side, they will be doing further consultation on company residency, so that might start to change. In that corporate space as well, you have Forex realisation events, you have Forex measures contained in Div 775 and Sub-Div 960C, because that's compulsory reading for everybody all the time. There are some concessions if you have less than a $250,000 balance for foreign denominated accounts, which sort of goes back to, I think, what Dane or Michael was saying about, you know, a business may actually have different accounts denominated in different denominations, and so how do they manage that for Australian tax purposes? And of course, the foreign income tax offset and the conversion rules. So that was a really quick trip around Forex and tax in Australia. But again, it's just being aware of what is out there and just knowing to ask the right questions and to manage those. And with that, we will hand over to Joel. Sorry to cut you off from the brilliant introduction, Dane, but Joel, over to you.
Great, thanks so much, Eleanor. I appreciate that introduction, Dane. I am one of the senior corporate client managers here at OFX. Today, I'm going to run through how to manage FX risk with some client examples. So let's start with what is FX risk. FX risk refers to the potential losses that an international transaction may incur due to fluctuations in the value of two different currencies, i.e. the exchange rate. It is also the risk that a business's financial performance or financial position will be impacted by changes in the exchange rates between currencies. First, we need to understand what type of FX risks your business is exposed to. These include transaction risk, economic risk, and translation risk. Transaction risk is the risk of buying or selling a product overseas and the adverse effect that an FX rate can have prior to settlement. Economic risk has more longer-term implications and can be created by macroeconomic conditions, government regulations, and geopolitical instability. Translation risk refers to the exchange rate risk associated with companies that deal with foreign currencies and have foreign assets and liabilities on their balance sheets. So once you've identified such risks, you need to understand how much FX risk your business can tolerate in volatile currency markets. You also need to set your objectives to manage long-term exposures to that FX risk. So in front of you, you have a graph. And on this graph, the graph on the slide is an example of the FX risk that comes with volatility during a global event such as COVID-19. If an importer was completely unhedged before the drop started in January at 70 US cents, your costs could have risen by approximately 20% by March and seen a reduction in profit margins. Furthermore, the cost differentials you'll see between buying at 57 US cents in March at the bottom versus 73 US cents in September on recovery was around 19,000 Australian dollars for a parcel of 50,000 US. So why does managing FX risk matter? Currency movements in general are extremely hard to predict. They may trend one way or the other with different levels of volatility. These movements can significantly impact a client's requirements over certain periods. So let's first look at the upside movement in a currency on the exposure chain reaction. If the currency you need to buy weakens against your home currency, your costs fall. Lower costs increase your company's profit margins. Higher profits boost your business capabilities, makes your business more competitive, and helps accelerate key investment decisions. Now let's look at what happens on the downside if you are unhedged in the foreign exchange market. If the currency you need to buy strengthens against your home currency, your costs rise. Increasing costs compress your profit margins. Lower profits limit your business capabilities, makes your business less competitive, and delays key investment decisions. So as you can see, with any type of risk, there's an upside and downside to consider. Businesses and individuals don't need to leave currency risk to chance. There are products designed to help you make decisions and help create more certainty. So let's go through some of these comprehensive set of products and services. Noting that these products are not exclusive to OFX, they are universally available through the FX remittance and banking world. So first of all, Dane touched on the global currency account that we have. It allows your businesses to get paid in foreign currencies through payment gateways and online marketplaces such as Amazon and Afterpay. These funds can be paid back to your local bank account or used to pay suppliers in the same currency, thus creating a natural hedge and eliminating FX exposures. You can view all your currency accounts in a single dashboard and integrate with accounting software such as Xero. We also have a limit order. So if you're looking to achieve a higher rate, you can import a target rate you would like to achieve into our system using a limit order for up to 6 months. Once the rate has been achieved, we'll take care of the rest. So for example, Aussie today, just having a look, is at around 77.5 US cents. So you could put in an order for around, let's say 78, so half a cent higher. Once that target rate actually hits that level, we'll automatically purchase the funds and give the client a call for settlement. Next, we'll touch on forward contracts. It is the ability to fix a foreign currency upfront at an agreed rate for settlement in the future to protect yourself against market movements. It is the product we have seen gain the most traction given the heightened volatility in the past 12 to 18 months. It is also the most common and easiest product to minimize currency risk. You can enter into a forward contract for up to 12 months through OFX. We also give our clients the flexibility to draw down off our forward contract multiple times before maturity. So for example, a client may look to buy a parcel of 100,000 US, for example, for 6 months. They might have multiple invoices that fall due within that period, and they'll be able to draw down as they do. There are also delays that might happen. It's been quite common in the last 12 months that there are supply chain issues. So we'll give our client the full flexibility to extend that forward contract should they not be able to meet that commitment when maturity falls due. We'll extend it to a new date and it can be used by them. So this product will also form part of the client examples discussed shortly. If you take a look on the right-hand side, we have some currency management tools. Rate alerts can be entered through our platform, and we will SMS or email a client when a particular currency pair is trending higher and lower or lower. We also have an OFX app, which allows you to receive notification for target rates and provide real-time currency rates. It also allows our clients to log in and execute payments. We also write daily and weekly commentary distributed to our clients via email, and you can subscribe on our website to receive one or both. So I'll just move on to the next slide, sorry. So let's bring this to life with some client examples. So we have one consumer and one corporate. The first is a typical property settlement for a consumer client. We had a client based in Australia who had purchased a property in France worth €1 million. We identified there was a transactional risk whereby they purchased the property on day one. A 10% deposit up front on the property was required for €100,000 and 90% balance on settlement in 12 weeks. So the client was concerned with the fluctuation of the Australian dollar against the euro within this timeframe. The potential downside movement for the Australian dollar before settlement would mean an increase in Australian dollar costs for the client for the remaining €900,000. Many scenarios were discussed with the client, and it was agreed the most suitable product to cover that FX risk was a forward contract. So how did each transaction occur and what was the outcome? So you'll see on the right-hand side there, the first entry was a spot rate. So there's an immediate cash flow up front for the spot transaction entered at 0.6465 for €100,000 on the 22nd of February. So we've received the Australian dollars from the client for that transaction, and then we've settled the euros to France. The client then at step 2 has entered into a forward contract on the same day for the balance of €900,000 to settle on the 21st of May at an agreed rate of 0.6445. So in terms of cash flow on this transaction, a consumer client will put up a 10% security up front to OFX on the contract for us to hold the euro position until settlement. So they don't actually need to put the full amount up front, it's just that 10% for us to cover our risk. Now on the client side, they've now eliminated any FX risk and they have their costs up front now known. So on point 3 on settlement, the client paid us the balance owing in Aussie dollars and we settled the €900,000 on the 22nd of May to France. You'll see that on the day of settlement, the spot rate was at 0.6360. It had moved lower. Thus, the client saved around $21,000 by hedging the position up front. Next, we'll move on to a typical Australian-based business who is an importer of goods. Within the corporate sector, it's a good idea to implement a currency strategy and hedging policy to minimize FX risks. Know your objectives and break-even levels. Having a clear oversight of your expected costs will minimize the surprises that will come with currency volatility. In the example, we have a client working off a cost base of 75 US cents to maintain known profit and expense requirements for the business. Their total exposure was $2 million to be paid within 3 months to their supplier. So on discussions with the client, they had a minimum 50% hedging policy for all contracts. As the forward rate on the 29th of January was higher than their cost base, they entered into a forward contract for $1 million at 76 US cents. So for cash flow purposes, a corporate client would put upfront a 5% security deposit to hold the position on day one till maturity, and then the balance on settlement. So then the client had flexibility on the remaining 50%. They could either use a mixture of the spot rate, potentially put in a limit order for higher rates, or should the Australian dollar fall lower, they could book in a further forward contract at 75 or above. So the end outcome was the client booked in a spot rate for the remaining balance of $1 million at 77.60 on the 3rd of March. So you can see there that they increased their total average rate to 76.80 over the full contract and achieved a successful hedge above their cost base. So this particular business has ongoing hedging requirements, just not for this contract, but they have multiple contracts. And it's important to mention that a client should look to hedge a percentage of all known exposures. They should regularly review their currency requirements and rebalance their average currency positions to ensure they're adhering to the policies and objectives set. So at OFX, we look to have hedging and FX risk conversations on a regular basis. We're here to help our clients discuss other products that exist in minimizing FX risk and change the rhetoric of leaving it to chance and taking the spot rate on the day. So conscious of time here, I just do have the one last slide here. We do have free FX resources to help manage those FX risks that I discussed. These will all be provided after the webinar, which you'll be able to click to view. We do have also a risk scorecard and exposure risk calculator. And we also do provide a monthly currency outlook to our clients. Just finally here, I'm going to pass back to Dane. He's going to explain briefly the partnership between CPA Australia and OFX. Thank you.
Thanks, Joel. I just wanted to cover off with the time we want to answer the questions as best as possible. But the one thing that's most important for us to convey is we've had a long-term relationship with CPA. We've invested heavily into that, mostly in people. So we want to open up the door to all of the members, the CPA members and your clients to be able to access these services. Now, that doesn't mean that you have to commit to any decisions, but our team are here to help take the people through the journey, to help guide them through the risk journey, and also just to really demystify the process. You're under no obligations to commit to a deal, sign up as a customer, but we really want to open that door to really clear out any concerns and demystify any of the pieces that may have arisen or any of the challenges that you have with your clients that we can help identify. What I might do is just hand back to Michael to help guide us through a few of the questions and make sure that we try to cover off as best as possible.
Thank you, Dane, Joel, and Eleanor. We've got a couple of minutes to kind of wrap up, but encouraging there are a couple of questions. So what I'll do, I'll start from the top. I'll do my best to cover what I can. Look, the first The first question is actually a couple of questions, but the first question is actually related to forward exchange contracts in particular. And the question is, what is the cost involved for setting up forward contracts for USD 100,000? So, you know, I'm conscious of how I answer this because the reality is there isn't any upfront costs in a true sense. Obviously, there is a upfront obligation and a commitment when you do enter into forward contracts. However, whether you're a consumer or a corporate, by example, again, there may well be a deposit requirement in order to secure that US dollar purchase. That deposit requirement, it could be deemed a prepayment, if you like, and the percentage of that prepayment is anywhere from 5 to 10% typically, you know, based on the underlying client type. But again, the costs aren't necessarily any different to that of a spot transaction. Obviously, the underlying exchange rate is calculated differently, as we've kind of provisioned for. But again, there isn't an upfront cost, you know, in a true sense, outside of that prepayment requirement. I'll pick up a second question here. Again, it's equally related to forward exchange contract usage. Again, it's to be honest, one that we do obviously pick up, and it does surface quite occasionally with a lot of our customers as well. And it kind of speaks to, if the FX rate was to move in a customer's favour or to one side, is their ability to cancel the forward exchange contract and pick up a more attractive spot rate? Look, the answer to that question is to say that, you know, when you enter into a forward exchange contract, very simply, there are a few obligations of a customer. You know, the first is, as I mentioned, there's a prepayment requirement on entry, whether it be 5 or possibly 10%. The second obligation is that there is a commitment there to settle the contract on or before the settlement date. You know, in the absence of being able to do that, again, you know, we're not necessarily in a position to you know, simply cancel forward exchange contracts, which again are probably out of the money versus the spot market. So there is a commitment, regardless of where the spot market sits, either which way. I would say as well, again, you know, Joel touched on it briefly as well, the underlying rationale behind, you know, forward exchange contract usage, you know, fundamentally kind of speaks more to, you know, frankly, risk mitigation. It is a fantastic defense tool. By design, they're not necessarily there to optimize the end rate that a customer might achieve. But again, it is more from a management orientation than it is a rate optimization, you know, kind of approach. Look, I probably have time for one more question. Just seeing which one to pick up. One actually is kind of related to, look, can we provide any, you know, financial background around the OFX group or Oz Forex Limited, as we may be known amongst the audience? How I will cover that is to say, look, OFX is an ASX listed company. You know, our balance sheet, you know, frankly, is incredibly strong. We're very fortunate to have 0 debt. We have close to 60 million worth of cash available within our balance sheet. And furthermore, as a public company, again, we have very recently, you know, released our annual financial statements, and the full spectrum of those financial results are available to all of our customers and frankly, you know, anyone who would like to understand a little bit more. There is a specific section on OFX.com, and you can do a deep dive and make an assessment over our financial background as well. Fantastic. All right, well, that's kind of a wrap for today. As I said, a very sincere thank you for everyone for joining us. It's been a pleasure to discuss a whole heap of different themes. A big thank you to Eleanor, to our audience, and equally to my colleagues, as I mentioned, Joel and Dane, for your time today.
Thank you, Michael. Thank you, Dane, and thank you, Joel. So hopefully that has demystified foreign exchange, and certainly if you do check out that OFX.com/CPA Australia site, you can have a look at what is on offer and how we work with our partners to help you explore the wonderful world of Forex. And with that, I will now hand back to Lauren.
Thank you, Eleanor, and the team from OFX, and thank you to everyone for your participation. In the next 3 working days, you'll receive an evaluation survey accompanied by the recording of this webinar. We really appreciate your feedback, as it's extremely valuable to CPA Australia to help us deliver better events for you. Thanks again, and we look forward to welcome you to another CPA Australia webinar soon.